Hello everyone, good afternoon and welcome to today's Professional Advisor Working Lunch, brought to you with our partner Baillie Gifford. I'm Katrina Lloyd and I'm Editor-in-Chief of Professional Advisor, and I'm going to be your host for the next hour. Before we get going with today's session, let me quickly run through our usual housekeeping. So I should inform you that this session is being recorded and we'll send you a link of the recording by tomorrow. Do feel free to share this with your colleagues. And as usual, today's working lunch will qualify for 1 hour of CPD, and we'll be sending you proof of attendance along with a link to the recording, which will arrive in your inboxes tomorrow. Let's move along my slides. There we go. So now let's get on with the session today. Japan's market conceals a treasure trove of growth opportunities beyond its familiar facade, with digitalization, niche manufacturing, and gaming emerging as just some of the country's hidden gems ripe for discovery by long-term investors. I'm joined today by Tom Patchett. He's an investment specialist director on the Baillie Gifford Japanese equities team. In this session, Tom will explain how their patient and flexible approach empowers BG to look past conventional wisdom, moving beyond stereotypes of salarymen and aging demographics to seize upon the innovators driving Japan's revival. So do feel free to put your questions to Tom using the chat function, which you'll find at the bottom of the screen. And if you wish to remain anonymous, then simply select my name from the drop-down list in the chat box before you type your message, so only I can see it. Just before I hand over to Tom, I'm going to take you through our learning objectives today. So by the end of this session, delegates will understand how to put the past into perspective and why growth could emerge elsewhere in Japan, understand some of Japan's leading areas of innovation, getting an insider's look at Japan's cutting-edge sectors from digitalization to niche manufacturing that are set to outperform expectations, and have learned how to successfully navigate Japan's cyclical fluctuations, leveraging a long-term approach to capitalize on the country's hidden growth drivers. So that's the CPD covered. So I'm going to hand over now to Baillie Gifford's Tom Patchett. Afternoon, Tom.
Good afternoon, and thank you very much for having me today, and thank you to those that are joining. So yeah, let's get started. I mean, in a world as unpredictable as a sumo wrestling ring, where heavyweights battle it out with wild abandon, it's obvious or natural to ask, why are we talking about Japan? Why are we focusing on a country that has fallen to third or fourth in some measures? Ranking in the global table? Well, we believe there are many reasons. Today, I'm going to give you two reasons why Japan warrants your attention, and then we're going to talk a little bit about how Baillie Gifford navigates this enigmatic market and packages this opportunity up for you in one fund. So let's begin. The first reason is Japan's relative appeal, which I believe is growing day by day. We're clearly living in very, very uncertain times of nationalism and jingoism, and this, understandably, is unnerving consumers and corporates and investors, many of which are probably seeking sanctuary from the insanity that appears to be emerging from some areas. Of course, Japan, sadly, is not immune from this. The US is a huge export partner of Japan, but unlike a number of other countries out there, Japan is benefiting from something special, and that is its own homegrown revival. So after decades of economic slumber, Japan appears to be emerging once again, and hence the purpose of this picture, a small bonsai tree, which is supposed to represent the symbolic sakura or cherry blossom that occurs this time of the year. So a new beginning. You've probably all read about the monumental nominal wage growth that trade unions and Japanese workers gained last year. 5+%, the highest increase in 30 years. If the economy, if workers can translate that nominal growth into real wage growth, then we could start to see the profitable flywheel of a wage price spiral take effect, whereby higher pay results in greater spending, consumption, which boosts company profitability, which feeds through back into higher pay. Once you have that, you have the makings of a self-sustaining cycle of economic growth. And I think that's arguably what the market is expecting, because despite the chaos that we're seeing overseas, the yield curve continues to steepen. The 10-year is now double what it was this time last year. And like a series of dominoes, this could have quite a powerful effect on asset prices. Firstly, by unleashing the firepower of cash-rich consumers and corporates. And secondly, by acting as another impetus to financial reform. In terms of the first one, you're probably all aware of the Mrs. Watanabe's cash coffers, the huge cash holdings that Japanese households have, which amounts to about 51% of household wealth within Japan, which is massive. That compares to like 15% of UK household wealth, which is in cash. Far more of their wealth is invested in the stock market. And if you add up that 51% of household wealth within Japan, it comes to about 1.1 quadrillion or $8 trillion US dollars held in cash and deposits. To put that figure in perspective, that is $2 trillion more than the entire market capitalization of Japan's market. So it's quite a hefty sum. Furthermore, you have another 160 trillion, $1.5 trillion of non-financial corporate cash as well, also held on the balance sheet. So there's a lot of firepower. And in the past, a lot of, that would arguably make sense, having a significant cash buffer, because cash would accrue value within a deflationary environment. That is no longer the case. With inflation, that cash holding by consumers, by corporates, that's sapping value. So there is a great imperative, great incentive to spend that, to put that cash to work. And that takes me on to the second point, which I mentioned, which is that this inflation environment could act as an impetus to improve, or for companies to improve their financial fitness, because you have effectively a higher bar, higher interest rates, and a greater onus on maintaining the real value of profits, or real value of cash flows into the future. So that forces them, it creates that incentive to consumers to put that cash to work and to improve the financial efficiency of your firm. And that arguably supplements the wave of activism and greater shareholder involvement that we're seeing across the market at the moment. And this isn't just academic, we're already starting to see the benefits of that, tangible benefits. So profit margins are higher than they've ever been. The return on equity for Japanese companies now is between 9 and 10%, on par with their European and Chinese peers, still less than America, but a lot higher than where they've averaged over the last 20, 30 years. And there's a lot more to go. So in summary, Japan is looking increasingly appealing. There is a lot more domestic spending power that's starting to come through. Fatter margins and less financial deadweight could collectively create a bit of a rising tide event for both returns and multiples, and those factors could ultimately attract more international attention. So Japan's no longer the cautionary tale that you might have become accustomed to. It is becoming more of a growth story, which explains the first appeal, the first reason why you should take note. The second reason for why Japan is that it provides you with access to accelerating growth trends. And today we're going to explore just 3 of those which exist within our portfolio. The first of those is the reflationary opportunity. And there are many ways to benefit from that, as you can see from the images here, whether it be through online brokerages, detergent, or Subway. These 3 are products and services of 3 fundamentally attractive businesses within our portfolio that we believe are primed for that re-energized economy, because all 3 dominate their particular niches. They are all dominant players within their markets. The top left-hand image refers to SBI Holdings. This is the Hargreaves Lansdowne of Japan, which hopefully has positive connotations for you. SBI Holdings is dominant within online cash equity trading. They've also created one of the largest financial ecosystems within Japan. So on top of that online brokerage business, they plugged other services. They've got a large asset management business, insurance business, private equity business. So they have become one of the biggest beneficiaries of the new NISA allowances, which there was a lot of fanfare about last year. And they should continue to benefit from greater domestic investment participation by Mrs. Watanabe as that cash is put to work. Despite that company compounding its top line at over 24% over the past 5 years, this company trades below book value at a very, very low multiple. The reason for that is that they continue to expand. They're still experiencing that growth strain, and that is putting pressure on their bottom line. To our minds, though, over the long term, that creates a fantastic opportunity, huge upside potential, both from further upside as the opportunity for them to disrupt some of those more traditional mega banks starts to take place, and from a re-rating as those earnings normalize. The next image to the right, that is Attack, the leading detergent in Japan. This is owned by a company called Kao, which is effectively the P&G of Japan. They've been around for about 130 years now, huge FMCG company with over 20 leading brands across skincare, cosmetics, and hygiene. You might be familiar with them if you use Molton Brown or John Frieda. They also own those two brands. And they're beginning to translate that brand leadership into price leadership. So they're starting to flex that market dominance and that pricing power, which we believe will continue to lift group profitability, group margins in time. I think the more exciting edge to this company, which is emblematic of others within our portfolio, is the longer term opportunity to expand within Asia and to capitalize on rising consumption within the region. As a market, Asia by 2030 is expected to account for half of all global consumption growth, from about 27% today. How similar to other Japanese companies, because of culture, proximity, strong brand portfolios, etc., should be able to capitalize on that. And that's to say that, as I say, is something that we are trying to capitalize on from a number of different Japanese companies within the portfolio. Finally, we have Tokyo Metro, which is the equivalent to the London Underground. This is a company that moves more people than live in Denmark every single day. It services 1/3 of the Japanese population that live in Tokyo, making it one of the busiest subway systems in the world. This company used to be shackled by government bureaucracy until it was liberated through its IPO last year, which we participated in. That freedom should give them the propensity, the ability to finally push up what have been pretty stagnating prices for the subway fares. And to put this in perspective, I'll give you the equivalent when comparing a subway trip in Japan to that of the London Underground. Back in 1991, it apparently costs about 80p for a single fare on the London Underground. That's gone up from 80p to about £7 now, cash fare and so on. The equivalent for Tokyo Metro, in 1991, it cost about 170 yen, and that over 34 years has gone up from 170 to 180 yen, 10 yen, which is about 5 pence. And I challenge you to think of anything that exists out there that's gone up by only 5 pence in 34 years. The point here really being is that there is a lot of potential for them to hike up prices. And I think consumer perceptions with regards to price hikes are beginning to change because of what we've witnessed over the last few years. And just to bring that point home a little bit further, when I first went to Japan 4 or 5 years ago, I remember a company explaining to me that they had raised prices. And they were so apologetic about it that the following weekend they released a they published a double-page spread in the newspaper, effectively apologizing for that. So it was almost antithetical to the culture of companies to raise prices. But that is beginning to change, and companies like Tokyo Metro should benefit hugely from that because of the high operating leverage that a business like that has. So a lot of that should feed straight through into the bottom line. So from finance, consumer product services, there are a myriad of ways in which you can benefit from Japan's reawakening. The second example I want to give you is gaming. And for those of you that aren't gamers, you may not be aware that this is big business. You know, this is worth 3 times music and Hollywood blockbusters put together. It's very, very big. And that is very fortunate for us because Japan is still home to the world's best gaming IP. And that is dominated, as you can see from the 2 pictures, by Sony and Nintendo. Looking through a short-term lens, these stocks are very, very cyclical. You know, the earnings and the sentiment towards them does seem to fluctuate with new product cycles. And obviously, Nintendo is on the cusp of releasing the second iteration of its Switch device. So there's a lot of volatility there. But through a longer-term lens, we believe these businesses offer huge and growing growth potential as they start to turn the tap on what are highly lucrative IP franchises. Sony, taking somebody's the first example here, is a very good example of that. You might associate Sony with basic electronics, but actually what makes this company unique is their dominance across 3 entertainment verticals. So they are a dominant player within the music, movies, and gaming industries. And the beauty of that is that they are able to take advantage of all 3 by cross-monetizing IP across those 3 platforms. And a good example of that is The Last of Us, which I think is quite topical, as they've just released the second series of this hit. This series actually emerged from a game which was released back in 2013. And it became a huge success in its own right, and was since turned into this TV series, which is the highest grossing HBO series ever. What that results in, or what that has resulted in, is what Sony management call the 2 + 2 = 5 effect, which is not just poor financial literacy. What they mean by that is that the sum is worth more than the value of the parts. And that's because not only do you attract a new audience to the TV series, that also helps re-energize and attract people back to the core gaming series. So this is how the kind of transmedia opportunities will start to play out for Sony as it turns games into movies and music. And they're trying to replicate that with some of the other gaming series that they have, or gaming franchises that they have. Nintendo is trying to replicate similar elements of that playbook. As you may or may not know, Nintendo is behind what is the most valuable gaming franchise of all time. And that is this Italian mustached plumber, Mario. They have begun to scratch the surface of capitalizing on this IP. As you probably saw, they released a movie a year ago. They do have now a couple of theme parks. They do sell some merchandise, but all of that amounts to a low single-digit percentage of group revenue. Tiny in comparison to, one of the leading companies, Disney, which has obviously been hugely successful at monetizing a lot of its IP. Their merchandise, movies, theme parks, etc., accounts for something like 45% of group IP. So again, a huge potential here for Mario, even if they were to just conservatively turn the tap and start to slowly monetize that a little bit more. That could have a significant impact on their margins. Both businesses speak to the kind of rich value that is latent within a lot of these Japanese brands, but which we are starting or beginning to see being unlocked. The final structural growth opportunity is that of digitalization. Japan is probably not the obvious home or place that you associate with this. There's no Mag 7. You probably can't even name one Japanese app that you have on your phone. It's obviously got a very aging demographic and an ongoing love affair with the tradition, paper, cash, and things like that. But those are exactly the reason why we think this is such a ripe opportunity, because there's such a lot of low-hanging fruit. And we are seeing AI and digitalization being adopted across the board, whether that's in healthcare, in cashless payments, or back office software as a service. The example I wanted to bring to you today was that of SoftBank, which is one of the most underappreciated players on digitalization AI, in my opinion. Despite its global footprint and well-known asset portfolio. You might associate this company with WeWork, but we think it now offers a lot more. Through their private equity portfolios, through their vision fund portfolios, you gain access to 10x Genomics, which is leading the way in whole genome sequencing, PayPay, which is Japan's leading QR payments provider, Coupang, South Korean e-commerce giant, and the list goes on. There's over 400 companies, as I say, within these vision fund investments. There is also Arm, the US listed, previously British owned architectural design company. This is their biggest asset now, and provides the brains for effectively 99% of smartphone chip architecture. So a very, very dominant and important role within the kind of AI ecosystem. Despite that attractive bundle of assets, the group trades at something like 50 pence in the pound. So a huge discount to the sum of those parts. We believe that discount will begin to narrow due to the huge buybacks which SoftBank continue to execute on, as well as a growing awareness and appreciation for what this company is doing and their role with regards to artificial intelligence. As I said, I'd argue that this is probably one of the most underappreciated plays on artificial intelligence, and would definitely recommend Lionel Barber's book on Masayoshi Son if you're interested in learning more. So to sum up those three themes, the reflationary, gaming, digitalization opportunities, these hopefully will provide you with just a small taste of the opportunities that are available beyond the usual stereotypes that surround this asset class. And what's more, we believe that, as mentioned, these bottom-up opportunities, attractions, are now complemented by quite an appealing top-down view or position for the asset class. So having explored the why Japan, we're just going to spend a few minutes talking about how, looking at how our team navigates this market. We frame Japan through a very unique lens. So as you'll know if you're familiar with Baillie Gifford, we adopt a very bottom-up, long-term, growth-orientated approach to investing. In terms of the first, this 82%, we back businesses and not the economy. Hence, we look very, very different from the index. So invariably, you'll see an 80+% active share to that of the market. We don't try and time markets or second guess macro factors or tariffs, because we think in decades and not quarters. So we buy and hold on that basis. And as a result, our portfolios tend to have a turnover that is reflective of that. 20% and below. It's currently 10%. which is far less than that of the average for the industry, 10 times as much turnover for some of our peers. That approach naturally attracts us to iconoclasts and entrepreneurs, owners like Masayoshi Son, who are willing to do things differently, who are passionate about the long term and not quarterly earnings expectations. And to see what others don't, we construct teams with cognitive diversity. We think it's very important not simply to for the team to look differently. It's about thinking differently, which is why we pluck people from fairly unconventional vocations. So our team consists of doctorates, computer scientists, lawyers, language majors. And the beauty of that is that it allows us to frame problems from a multidisciplinary perspective using different mental models to some of our more conventional competitors. So, for example, Matt Brett, who is the manager of the Japanese fund, with his doctorate in child psychology, might see something slightly different to what Praveen's computer scientist mind may not. And we do everything out of Edinburgh, which allows us to lean on other teams, which is obviously very important because Japan and Japanese companies clearly do not operate within a vacuum. So we can lean on some of our international colleagues where appropriate, if it's a key end market for a company or if there's similar business models being played out. These dynamics allow us to produce a portfolio that in aggregate has grown faster than the market, is expected to continue growing faster than the market. Yet, if you strip out SoftBank, which is more of a holding company versus an operating company, trades almost on par with it. So to us, that presents quite an exciting opportunity going forward. To wrap things up, do full circle on my sumo wrestling analogy. Whilst things are looking quite ugly at the moment with several battles being fought, this one here with sumo wrestler Tokushoyo Makoto, who was a former underdog of Japan, is the one you should be paying attention to. He, like Japan and the companies that exist there, are on a far clearer path to success, in our opinion. So with that, I'll save your eyes and move forward to the next slide. I'll open it up to questions. Thank you very much.
Great. Thanks so much for that, Thomas, for taking us through that. We're going to be looking at some questions now that have come in. I'm just going to get those up here. And just a reminder that you can please add any questions as well for Thomas on the chat and the question box just on your screen there as well. Thomas, are you maybe if you stop sharing your screen just for a second, because then I can I'll hopefully get an image of you up and it'll make it easier, I think, when I'm doing the questions to see you in person, if that's okay. There you go. Great. Thank you. Okay, Thomas, if you're ready, we'll just go through some of the questions we've had that have come through. Okay, so given the efforts to improve corporate governance, why, in your opinion, is the growth side of the market more attractive than the small cap deep value side?
Yeah, sure. So I think the corporate governance efforts that we're seeing, first of all, I don't think there's anything new there. This is just another chapter in a long-going saga that's been in existence since the Koizumi reforms, Arbonomics, Stewardship Code, Corporate Governance Code, and now the TSE has effectively taken on the baton, encouraging companies to raise their game effectively. So there's nothing new here. I don't think it's going to be the catalyst that there's a lot of investors expect to re-ratings across the entire market, but it is definitely moving in the right direction. So I think it is definitely a positive, and I think it's a positive move for all companies, not just value companies, but growth companies as well. And the reason for that is that cash hoarding and inefficient balance sheet structures exist across the board. not just in your more traditional latent growth type value stocks, but also in early stage growth companies. We've got a lot of businesses, software as a service type companies, robotics companies, digitalization companies that have culturally hoarded significant amounts of cash on their balance sheet. So I mentioned during the presentation that there's about 156 trillion of cash held by non-financial corporates within Japan. About 1 trillion of that is held by a company called conceals, which is a leading robotics and automation company. They focus on the sensory systems, effectively the eyes for robots. And this is a huge growth market, given the proliferation of robots beyond the auto segment. And they're at the sweet spot of that. The company has grown at double-digit rates, has 50+% operating profit margins, so all of the characteristics that you'd expect from a high-growth business, yet a significant chunk of cash on the balance sheet. So with this new wave of corporate reform and great encouragement and pressure on companies to address some of this dead weight, they may, similar to others, decide to actually pay out some of that cash. So we, as growth investors investing in conceals, may benefit from this corporate governance wave in similar waves to a whole host of other companies and investors within Japan. What makes us different is that it's not corporate governance reform and balance sheet improvements is not going to be the only driving factor behind our decision to invest in a company. We are looking for structurally growing companies where there are several tailwinds, several triggers, drivers to earnings growth. Corporate reform, balance sheet efficiency might just be one of them. And I think that's what's really important. That's what differentiates us to a deep value distressed investor within Japan who's looking for a little bit of an unlocking of value and then they cash out. We're looking to invest in companies because of the structural growth tailwinds they are riding over the next 5-10 years. Balance sheet improvement might be one of those things that helps us along the way.
Great, thanks very much for that. We've got another question here looking at growth and value. How do you see valuations for growth companies relative to value? And do you expect growth to outperform in the coming years? And that maybe links as well, obviously you have the growth style there, but maybe links to another question around underperformance of the BG Japanese fund compared to the benchmark over 3 and 5 years. A question asking about the reasons for that. So maybe you could take us back a little bit and then think about how you see things going moving forwards.
Yeah, sure. So yes, you're right. I mean, we've had a very tricky performance period over the last 2-3 years. I think that's because Japan has been a value market. Stylistically, we've been massively out of favor. And there are many reasons for that, but I think you can pinpoint them down to, or drill that down to 2 core factors. One being COVID, the other being currency. COVID effectively halted the Japanese and global economic engine. So the bounce back in activity really helped a lot of those cyclically exposed or sensitive businesses. For Japan and for Japanese auto companies and shipping companies, they were further bolstered by the weakening of the currency. The yen lost a significant amount of value against the dollar and a whole host of other currencies during that time period. So you had that double tailwind. So that resulted in margins for a lot of these cyclical companies reaching multi-decade, if not all-time highs. And against that environment, we were effectively drowned out. Looking forward, we think the entire situation is likely to change in our favor because of those factors are weakening in some cases and reversing in others. And the yen would be a good example of that. So it went from 110, 111, around that level versus the dollar before COVID to 150, 160. That's a significant depreciation, not something you expect of a developed country economy like Japan. That really helped the earnings for a lot of these cyclical value export orientated companies. But that's now shifting. That's now turning. The yen has strengthened significantly year to date. We don't know where it's going to go, but there's probably a lot of arguments as to why it could continue to strengthen, given the central bank in Japan are going in the opposite direction, it appears, than to a lot of other central banks around the world, because of that inflationary picture that I explained earlier in the presentation. So the stimulus, the factors that really helped a lot of these cyclical businesses, a lot of these value businesses, are starting to dissipate. You contrast that with where we are and what we're focusing on, which is companies that are trying to capitalize on secular growth stories, which are actually accelerating in Japan because digitalization continues to progress in terms of the technological improvements that we're seeing across a whole host of fields. At the same time, the demographic picture has got so much worse. The baby boomers post Second World War, and now in their 70s, 80s, they're starting to retire. So the labor market is shrinking, and it's becoming more expensive because people are demanding higher wages. So that is increasing the incentive for businesses to shift towards digital growth-orientated type solutions, which really feeds the cash flow for a lot of the companies we invest in. And on top of that, and this relates to the first part of the question, the valuations, they're not priced for that growth. A lot of these companies got significantly derated post the kind of internet craze of COVID, and still attract multiples far lower than they did previously. So I already mentioned a couple of these companies within the presentation. SBI Holdings, the Hargreaves Lansdown equivalent, that trades at less than book, on par with a number of other traditional offline financial companies within Japan. So that seems to be massively anomalous to us. SoftBank Group trades at 50 pence in the pound. We've got a whole host of others. Rakuten, which is Japan's largest online ecosystem. It offers the equivalent of Amazon in terms of its Chiba online e-commerce site. EE, it's got a mobile telecommunications business. American Express, Booking.com. It's got all of these things. It's got about 70 different online services. Because this company has been spending heavily on building its own mobile business, its earnings have been depressed. And it's been massively derated as a result of that, because in a time of higher interest rates, people don't want to pay up for uncertainty. But we think this company is fishing in so many growth ponds. It has, as I said, 70 online services, the biggest online ecosystem. It is collecting data at a faster rate than any other company within Japan, which is going to fuel its own utilization of AI, making the entire business more efficient and greater able to, or more capable of benefiting from cross monetization across its platform. Yet that business trades on 0.7 times sales. So you don't have the chasm as you do in other markets, with growth companies attracting very, very high multiples. There are a lot of really attractive growth companies within Japan that trade on par, if not less, than the overall market. So the valuation argument provides another huge potential opportunity for us as growth investors.
Great, thank you very much for taking us through that. I've got another question here. Japan appears to have all the makings of a lucrative financial market. Most fund managers cite the third largest economy, etc., but the returns rarely match up. Do we simply have a fundamental misunderstanding of how their markets work?
I mean, yeah, that's a deep question. The philosophical underpinnings of Japanese capitalism are very different to that we are conscious of in the West, but that is starting to shift. It's shifting more from stakeholder to shareholder, and we're seeing balance sheets evolve in response to that. So I think the makings are there, as I already mentioned. Profitability, return on equity, all of these metrics are starting to improve for the portfolio as non-core subsidiary cross shareholdings are paid out. Property, which has been held at cost for the last 20, 30 years by companies, that is starting to be realized. And cash, the biggest drag and costly drag in an inflationary time as we're seeing now, that is also being paid out through buybacks, which continue to climb year on year. reaching new highs within the Japanese market. So I think the Japanese market is taking note and becoming more of an efficient beast overall. So bringing it full circle back to what I mentioned in the presentation, I think those factors, as they start to improve, will start to gain investor attention overseas, and this could become a much bigger part of investors' portfolios going forward because of that.
Yeah, and you mentioned some of those stereotypes that people have about investing in Japan, which are starting to shift, but that could maybe be a longer story, changing people's minds. As you say, you're identifying some of these growth opportunities here, but it's really maybe just changing that narrative a little bit around what we would maybe perceive as being what investing in Japan might be like.
I think so. I think the biggest one is usually the demographic demise. It's got the worst demographic profile of all developed countries. But again, you can turn that on its head and see this as a huge opportunity for those companies that are nimble enough to see that. And so, as I already mentioned, if you've got an aging, more expensive demographic profile population, the payback period for investing in automation or digital intermediaries and things like that increases. So we're seeing a lot of companies actually feed into that benefit from that demographic tailwind. So there's a lot of low-hanging fruit through land grab and consolidation stories within the domestic market, which make this quite a fruitful opportunity, despite what's happening in the wider world.
Yeah. Thanks for that. Yeah, so we've got a few minutes left. So I wanted to talk a little bit more depth around tariffs, what we've seen over the last few weeks. As we know, it's an ongoing situation, and while we're talking, things could have changed again. So let's just talk a little bit more about it. As we know, there's some big meetings happening this week with Japan's finance minister going over to the US to try and negotiate there. I mean, just in terms of what the team did, how the team's been approaching this over the past few weeks in terms of assessing companies in the portfolio. It must be hard, I suppose, with so much unknowns and because things have changed, seems to be changing so much day to day. But how have your team kind of gone about looking at this?
Yeah, no, and I think you actually make a good point. There's a lot of fighting talk happening at the moment. I think one thing that puts Japan in a slightly more favourable position is that it seems to be more conciliatory with the US in navigating these tariffs, which should put it in a slightly more favourable position relative to some other countries. In terms of what we're doing and how we're attacking this, we've obviously stress tested the entire portfolio, looking at supply chain vulnerabilities and on the demand side, which countries are reliant on the US consumer. And there are a couple of companies which obviously flagged within that, which we're well aware of. Companies like Kubota, which makes small horsepower tractors and construction equipment, or Fanuc, which is the world's leading maker of industrial robots, and Bridgestone, which makes tires, one of the leading tire manufacturers around the world. In all of those cases, short term, yes, there could be some volatility around their earnings as the companies try and navigate the on and off situation with tariffs. In the long term, though, the thesis remains intact. So for Kubota, we think the greater opportunity lies not in America, which is still currently the largest, accounts for the largest percentage of its sales, but actually in Asia. So they acquired an Indian business a few years ago, and they're starting to use that as a window to entering other Asian markets, which their pedigree servicing Japanese paddy farmers make them well astute for. Fanuc may actually be a beneficiary of this geopolitical situation in that they are producing robots which have greater utilization application beyond just the auto manufacturing line as traditionally assumed. They are expanding now into other industries. And as COVID did, and as this current tariff spat is doing, a lot of companies, I think, are becoming very, very conscious of the vulnerabilities of their supply chain. So we're seeing a lot more nearshoring or reshoring, which should play into Fanuc's hands because they are the leading provider of very, very sophisticated CNC machines, robotic and industrial machines, which companies are going to require, American companies are going to be required if they want to build up their own domestic manufacturing base in various different fields. So the long-term case remains pretty solid for those, even if their share prices suggest otherwise in the short term. Taking a step back though, and just giving you the kind of relative picture as well, Japan, as I mentioned at the beginning of this talk, is quite vulnerable. It is a big exporter to the US, but the majority of those exports are actually cars. Toyota, Nissan, and a whole host of others. Toyota obviously being Japan's largest company. We don't own any autos. We sold out quite a few years ago because we were actually worried about the longer term implications of the shift from ICE to EV, which Toyota and a whole host of other Japanese companies have been pretty late to. We've also reduced a lot of our cyclical export orientated exposure because of those factors which I mentioned earlier, COVID, currency starting to dissipate. So we've become a little bit more domestically orientated, which I think should put us in a better position relative to the overall market, regardless of how this tariff spat plays out. But ultimately, you can conclude on this question with bringing it right back to our philosophy. We are long-term, bottom-up, growth-oriented investors, and that does insulate us to a degree from acting impetuously to some of these capricious market events. Ultimately, we do believe that if a business does well, the stock or the share price will ultimately follow, and that long-term patient approach has allowed us to stick to our knitting. And if you look at the Japanese fund and what we bought year to date, it's one company involved in dentistry, another bicycles, and Square Enix, the company behind Final Fantasy. So we're not trying to game the macro picture here. We're sticking to our knitting, which is to identify companies that are at the forefront of growing structural growth trends, which will outlast this presidency and a whole host of other issues, which I'm sure will rear their head in the near term.
Yes, there's a lot to discuss, isn't there? And I suppose it's hard, as we said, because of things moving so quickly at the moment. But I suppose looking into the future, it'll be interesting to see how this does affect longer term international trade relations. We've already heard, that China's been preparing this for a while, and Japan probably as well, and it could create different relationships, particularly within Asia, and people focusing more there. And there might be, do you see that as being some interesting opportunities? As you said, them looking at their supply chains as well. It will make people reflect and maybe think about things differently, even if the tariffs do get negotiated down in the coming weeks.
Yeah, and obviously you have to. It's hard to generalize across the entire portfolio. We try and incorporate macro factors, changing assumptions on a case by case basis. But again, what insulates us from a lot of these ephemeral factors is the fact that we do have that long-term growth quality bias. So when we look at a company that does have significant and growing exposure to an overseas market, we're only looking at companies where they are likely to have a clear and definable and growing competitive edge, be it through brand, their distribution network, or whatever it might be, or the unsubstitutable nature of the complex products. So that is how we try and offset or effectively manage the risk that comes with investing in a geographically diverse business, or a business that is clearly reliant on other markets.
What are you hearing from company management at the moment? It's a very uncertain time. We've heard that, a lot more broadly, a lot of companies pulling back from investment, just rethinking things, retrenching while they see how things play out. Did you worry that could impact some of their more immediate growth plans, or what sort of sense are you getting there?
Yeah, well, I mean, so the timing of this, these tariff announcements came in at the beginning of April, which is the start of the new fiscal year, financial year for a lot of Japanese companies. So I think a lot of them quickly reversed any kind of expectations they had around currency and a whole host of other factors. I think a lot of Japanese companies have been trying to increase the transparency in which they provide guidance over the next year or 3 years, or indeed quarter. So a lot of them were quick to revise what they had released, and many of them have actually pulled back on releasing any kind of guidance whatsoever. And that's not good in the near term. I think that if anything, that will just trigger and fuel the speculative volatile fire that we're seeing in a lot of markets at the moment. In the long term, though, a lot of the companies that we continue to see on company trips, on visits to Japan, clearly remain quite focused on their individual business and what they are doing, and the growth that they are still seeing coming through, which I think is really reassuring for us, that behind all of these headlines, there are some very, very strong businesses that are continuing to deliver value or take costs out of the systems for their clients, which ultimately will be rewarded by shareholders in the long term. And that's what provides us with a huge degree of comfort during these turbulent times.
And just finally, I just wanted to ask you a bit more. You mentioned a lot in the presentation, but about those developments in terms of AI in Japan, and how you're gaining exposure there to them. Maybe you can just say a little bit more about looking forward, what you think is really exciting about that sort of part of the market, and how Japan's involved in that.
Yeah, sure. As I mentioned, I think Japan has a fairly unique societal challenge at the moment, because of its aging population and that labor shortage, and the fact that there are so many antiquated processes that are still in play. And that creates a huge opportunity for AI to be adopted across a whole host of different areas. And the general perception towards AI is very different to what we're seeing in the West. There isn't the fear of job losses. If anything, I think people are quite keen to adopt it as a means to offset the pressure that the system is under at the moment because of its demographic picture. So it's a really fruitful opportunity for AI. And as I said earlier, we're seeing that in a whole host of different companies. Rakuten is a really good example of that. The online ecosystem business, they're using it in various different ways to increase that kind of cross monetization, cross use. So people buying their travel and then using their Rakuten credit card and then shopping online. There's a lot of data you can amass and improve the service that you're providing through that. We've also got another company, CyberAgent, which is effectively changing the economics of advertising by using AI. CyberAgent have been investing in artificial intelligence tools since 2016. They're one of the biggest Asian investors within this space, and they have been using AI to create avatars of celebrities that are bespoke to the individual. So when you're scrolling across a page looking at something, you'll be hit by this avatar who will look, sound, be dressed differently depending on the user and their browser history, which is a peculiar thing to get your head around, but it improves the efficiency of advertising and the click-through rate. And obviously, if you're able to create bespoke advertisements for every single user, the efficiency of that, the payback of that, versus one banner for all, as used to be the case, and is still very much a big part of the advertising industry within Japan, that offline channel. You create huge opportunity there as well. So and we're seeing it in gaming and a plethora of areas. So there's a lot happening here, and it is becoming quite exciting as to what this technology could do within a market that is in desperate need for it. So yeah, it's definitely something we're capturing within the portfolio, and something we're continuing to watch closely.
Great, some really, really interesting opportunities there. Well, thank you so much for joining us today. Before we wrap up, let's just take a quick look at those learning objectives again. So by the end of the session, you should understand how to put the past into perspective and why growth could emerge elsewhere in Japan. understand some of Japan's leading areas of innovation, getting an insider's look at Japan's cutting-edge sectors, from digitalization to niche manufacturing, that are set to outperform expectations. Have learned how to successfully navigate Japan's cyclical fluctuations, leveraging a long-term approach to capitalize on the country's hidden growth drivers. Thanks again very much to Tom for taking all our questions today. If you have a question that you want to ask and didn't get answered, Tom and Baillie Gifford will do their best to do so. And again, I remind you that CPD will be delivered tomorrow. Just before we go, I want to just share a little bit of a teaser of some of the events that we have coming up on Professional Advisor. So next Thursday on the 1st of May, we're going to be hosting our huge annual PA360 conference in London. This year's conference has an eclectic collection of over 40 speakers covering everything from investment, technology, protection, platforms, retirement planning, M&A, and of course AI. And we'll be also speaking to our keynote speaker, Alistair Campbell, who'll be looking back at the first year for the Labour government. I'm very much looking forward to seeing you at what's now firmly established as the largest annual management conference for financial advisors in the UK. And then on the 14th and 15th of May, we'll be running the third edition of our very successful Professional Advisor Management Retreat at Wootton House near Dorking in Surrey. This is a 2-day conference aimed at those who either own or are senior directors of advisor firms. And over the course of the 2 days, you'll have the opportunity to attend boardroom sessions from our sponsors and listen to some fantastic presentations from a variety of outside speakers. Meanwhile, our next online lunch is on the 5th of June and features a new partner, Flagstone. We'll be joined by their partnerships manager, who's going to discuss how advisors can add value to clients by supporting them with cash. And then at Professional Advisor, we don't want to be thought of as having Southern bias. So this year, on the 18th and 19th of June, we're launching our new Northern Retreat, which will be at Carden Park near Chester. And just like the management retreat, there'll be lots of boardroom sessions and a host of plenary speakers. So you should be able to find all the details that you need on the Professional Advisor website. All in all, that's a total of 20 hours CPD over the coming months. And as I said, if you wish to find out more or sign up to any of the events, you can do so by visiting professionaladvisor.com/events. So that's it for today's session. Thanks once again to Tom for joining us today, for his presentation and for answering our questions. And as always, huge thank you to you for joining us. We hope you found this session helpful, and we hope to see you again very soon.